Well, good afternoon. My name is Andrew Romans, and I'd like to thank everyone for coming. And first, I'd like to thank Carrie Walsh and everyone at Silicon Valley Bank for hosting this evening. So let me just pass to Carrie to say a few words.
Thank you so much. So good evening, everyone. Thank you for joining us for our Oktoberfest author series. We are so excited to have Andrew and our illustrious panelists here tonight, who are really some of the best-known names in venture capital today. We're really excited to bring this type of event to you. The Entrepreneur Services team at Silicon Valley Bank is really all about finding innovation in the market. And once those companies are working with us, we really try to connect them in very thoughtful, curated ways. And this author series is really just one example of how we're trying to bring insights to entrepreneurs in a way that you can take home and use in your business and leverage in your day-to-day operations. So the panel is amazing. The insights that Andrew has garnered in his book, I think, will be informative and useful. Please enjoy the night, enjoy the German food, and definitely network like crazy. So thank you.
Thanks, Ian Carey. So just quick on the format, we'll moderate a short panel. I'll open to the floor for questions. So think of questions now. While we're waiting, I don't want to introduce this panel without pitch. So I'll just get started and talk about how this whole thing happened. So I spend most of my days with CEOs, angel investors, VCs, lawyers, corporate development guys. And often these companies are looking to make a decision. Do we raise more money? Do we make a major staffing decision? Do we sell the company? Any kind of decision. And I often tell stories and give advice. And I often say, this is what some other guy did. And people started saying, I wish I knew then what I know now. You should write a book. And I thought, well, maybe I'll start writing down these stories and do it. And eventually I decided to say, well, I know the guy who this story happened to. Why don't we have him tell the story? And so I started collecting stories from lots and lots of people. And then I decided to turn to many in my network and ask them to contribute stories. And these stories came in from lots of people, like Pitch Johnson and Kathleen Barr, and getting Gary's perspective on the Instagram acquisition and things like this. And we pulled that together into a book. So now that we're all together, I'll stop that, come back to it later, and I'll introduce the panel and we'll get going. So Gary Johnson is a director of corporate development at Facebook. Prior to that, he was doing investment banking deals at Credit Suisse, and I believe he was at Apple before that. And I guess unlike Zuckerberg, he completed his degree at Harvard and went on to get an MBA award. But they're working closely together on buying companies at sensible valuations, as we all know. Pitch Johnson is, one of the godfathers and legends of Silicon Valley, can be considered a founder of Silicon Valley, and we'll get into that. He founded Draper and Johnson quite a number of years ago, and then went on to set up asset management ventures, where he was fortunate enough or smart enough to invest in companies like Amgen, which, when I checked this morning, was an $87 billion market cap. But there's lightning struck quite a few times for Pitch, and he's got a unique perspective on venture, mainly investing a lot of his own money rather than just all the forces on LP, returning LP dollars. Kathleen Barr is a general partner at Moore David Howe. She also teaches a class at Stanford on negotiation, and I was fortunate enough to have her contribute to the book and give insights and advice there, which I'm hoping she can share with us today. Most entrepreneurs don't know how to read, so it's good to come to these things and hear it directly from the source. Kathleen, I think, is in her native Canada, went to McGill undergrad, right? And then Stanford for graduate school. Pitch was at Stanford a bit earlier in undergrad, and Harvard MBA, back when that was the only place to get one, I suppose. Peter Nia is a partner at Lightspeed. And when I asked him in very short notice and putting this panel together, can you come? He moved some meetings to come, so thanks for coming, Peter. And Peter's been in the venture capital industry since 1995, is that right? And he's been smart or lucky enough to invest in companies like DoubleClick And his fund, like Catherine's, is one of the titans of Sand Hill Road, multi-billion-dollar fund. I think Catherine's latest fund is 750? 700 million. So we can talk about fund physics and how you do that. Your fund, I think, is 735, 55? 675. Yeah, so these are large funds. Yeah, these are large funds. And Steve joined us as a partner from Venrock. Venrock, for those that don't know, was originally the investment arm of the Rockefeller family office. So I think Lawrence Rockefeller was a grandson of J.D. Rockefeller. In the 1930s was making investments. So between them and Bessemer, they get in fistfights about who's the oldest VC in the country. It's probably Venrock, right? But they formalized that, I think after Pitch had set up Draper Johnson, formalized Venrock as an actual 69. So late to the game, but had been investing earlier. And of course, these guys invested in little companies like Intel and Apple. So they've got a story when they go to raise LP dollars. So that may sound like it took a long time, but if I let them do it themselves, we'd never get out of here. So with that, why don't we get started? Pitch. I think we're sharing microphones here a bit. Pitch, why don't you talk to us a little bit about the early days of Silicon Valley and how things got going?
When I first used to come to these meetings in the 60s, people would say, where do you think the venture capital business is going? And a little later on, they'd say, where do you think it is? And now they're asking me, where was it? But the short version is, I wanted to be a production guy when I got out of business school. In the Korean War, I didn't do any fighting, but I went in the Air Force during the Korean War. And then when I got out, I got a job at a steel mill in East Chicago, Indiana, although I was from the Palo Alto area to start with. Anybody who grows up in Palo Alto should work in a steel mill for a while, I'll say that much. Anyway, and while I was there, another HBS graduate that I didn't know at school because we didn't overlap because of service requirements was Bill Draper. And so, although we lived near each other in what you call company houses, which are an old custom where the company built houses and rented them to employees so they could at least live in a clean place at decent rent. So we became quite good friends. Kathy and I, who's with me, and Phyllis and Bill became quite good friends. And so in 1959, I was there from 54 to 62. In 1959, Bill left to come out to Palo Alto, which had sounded attractive to me, to join his father in a really pioneer venture fund formed in 1959 called Draper, Gaither, and Anderson. So then Bill wanted to be on his own eventually, although he remained very, very close to his father. So in late 1961, we came out to the big game, which all of you know what that is, of course, except for Harvard guys. And we decided to form an SBIC, which was a government program that actually worked. And you had to put up, I saved up some money, I borrowed some money from family, he did the same things. So we came up with $75,000 each. And we were able to form this SBIC, which had some money from the government to form the company, and then we were able to borrow money at a low rate. So we had a power of investment of about $4 million altogether. So we got going in 1962, and we did some deals. I don't think we'll start talking about deals. I'll use up my 3.5 minutes or whatever it is. But so then in 1965, two things happened. Sutter Hill Ventures was getting going, and they liked our portfolio. And I thought of myself as more of a player than a coach. Venture capitalists are sort of like coaches. And so it worked out fine because I never had any capital before this, by the way. So they gave us $200,000 or $300,000 for our companies. And so I was able to go look for a company to buy because that's what I wanted to end up running a company. Bill then joined Sutter Hill and was a very important factor. He and Paul Wise and making Sutter Hill the great company it is and was. So as I went out with my little pocket full of money to buy a company, guess what? I found deals. And so I found a little biotech deal. I found a little a software company, a pioneer software company called Boole and Babbage that we helped start. And so in the end, I ended up on my own. got pretty busy, so I hired a very able young assistant called Brooke Byers, who came and joined me and did well, both then and after. And so I've been on my own ever since. I don't think we have time to go through all the deals. Amgen was a good one, though. And that wasn't my invention, though. That was Bill Bowes thought up that idea, including, he had 3 companies called Applied something. Applied Molecular Genetics, which was Amgen. Applied Biosystems, which was a company that analyzed proteins. And then a company called Applied Microcircuits, all of which succeeded. So that was a great start. And Bill Bowes was a Stanford and Harvard Business School friend, so I value that friendship, let's say, in more than dollars, though. So then we've gone on and raised some outside money for a while. The universities came to us and some institutions. And then about 7 or 8 years ago, the guy, I was much more interested in private investment, so the guys that were with us then formed Alloy Ventures, and they've been managing outside money ever since. And we have been primarily inward directed. We have 2 or 3 funds, that almost all of which are our own capital. When that goes well, it's really good. When you lose money, you lose your own money, so it's kind of a nice balance. Right now, things are pretty good, as you all know. So I ended up as a limited partner only. Our last 2 funds have not been a general partner. I'm tender age of 85. I've got to begin thinking about some kind of retirement. I've failed so far. So I think that's my 5.5 minutes, and so it's been a great business. And to call us pioneers, when the people got their covered wagons and came west, they thought of themselves as pioneers, I'm sure. Draper and I had no idea we were pioneers. We thought this would be an interesting way to earn a living, feed the kids, and maybe make a few bucks. So that was our attitude.
Well, thank you, Pitch. We'll come back to the future of what you're doing with your new healthcare IT fund as well. Catherine, maybe you could talk a bit about some of the points you contribute to the book, or really anything at all, but negotiations, or how to negotiate with a VC, perhaps.
Sure. So before I joined More David Howe, I was actually a negotiator. That was my job for a number of years. I worked for a firm that was a spinoff of the Harvard Negotiation Project, and I worked directly with the guys who wrote the book Getting to Yes. So we kind of get trained for the first year, and then after that they sent us out on the road, and we were negotiating deals with customers, suppliers, outsourcing service providers, even between divisions, sometimes within companies, because the softer side of business, relationships, negotiation, a lot of people don't like to talk about that, but that can often blow up deals and blow up relationships. So interestingly enough, it's been highly relevant to my work as an investor. I teach a 2-day course at Stanford on this, so I could go on for a long time about it, but just a couple of points I think I'll make that I've sort of observed as being really impactful in the venture environment is focusing on, for those of you who know Getting to Yes, focusing on interests versus positions. I see it happen every day. People get stuck in the position. I want this, I won't do that. And if you ask why and get underneath it to the interest, you can often get past the impasse and really focus on coming up with creative options. It's really part of the lens through which I look at any kind of problem-solving situation. And the second one is really a focus on relationships, that often when you're trying to influence or close a deal or close a partnership, whatever it may be, it often comes back to building a relationship with the other person. And it doesn't have to be a really close partnership, it's just understanding what the rules of the road are and what the expectations are. So I try to make a point in the entrepreneurs that I work with in setting expectations really early in terms of their and our objectives. You know, are they in it for the long term? Or are they looking to build $1 billion company, which is the only kind of thing that's going to actually move the needle on a fund of our size? And just anything that could potentially come up, try to cover that early on. And I think generally just looking at a relationship between the entrepreneur and investor as longer term. I love Mark Suster's comment that it's lines, not dots, so building longer term relationships. And then everything you do in any sort of conversation and communication, it has an impact on the relationship. So if the entrepreneur tries to overgame the system, that can have an impact. I've seen investors pull term sheets from entrepreneurs who are trying to overgame the whole investing process. And then in the actual discussion of the terms, it's really important to actually sit down with the investor, so between the entrepreneur and the investor, and talk about what the business terms are going to be before you involve legal at all. You can certainly get advice, you need to be informed going into the conversation, but I've just seen far too many times, both as a negotiator and now as an investor, where as soon as you bring in the lawyers and you have sort of disintermediation happening and redlining happening, things can become very positional and very emotional, and for really no reason at all. The miscommunications can come up. So sitting down and sort of hammering out what the key business terms are between the investor and the entrepreneur up front before bringing in the lawyers, I think is a really important thing. So that's just a few thoughts.
And Catherine, you've talked about, with me in the past about when an entrepreneur says, okay, I actually was just across the street at DFJ, and then NEA is interested in my deal, and then you happen to be having lunch with Tim Draper or Scott Sandell, and they say, we passed on the deal. Maybe what's the advice because I've seen entrepreneurs even purposefully checking in on Foursquare saying, this is where I'm at. I'm at 15 locations on the same road.
Well, that's sort of to the gamification point that, for better or worse, Silicon Valley, I mean the world in general, but Silicon Valley is a very, very small world, and it's a very open flow of communication. So on both sides, the expectation should be to at least not share information that is materially incorrect, let's say. So I've certainly seen that situation where somebody says, yeah, well, I've got an offer from so-and-so, and it turns out that so-and-so, as you said, passed on the deal. So.
Gary, with all of your days in your career, and of course here at Facebook, you're facing the same thing. What is when an entrepreneur is shopping a deal, or at what point should they make sure if there's a no-talk clause, or maybe some advice on how Facebook views that?
Yeah, I think, and Catherine touched on a couple of really good points. Selling your company and a lot of times is very emotional. It's probably one of the most deeply personal decisions that the person on the other side of the table from me or from one of my colleagues is actually ever going to make, right? I mean, we, back in the day, were approached with similar offers to sell our business, and Mark, fortunately, had the foresight to not do that at the time. And it's actually something where we really spend a lot of time building trust. It's about that alignment. 10% of successful M&A happens at the term sheet and DA phase, right? What I do on a day-to-day basis is actually work towards strategy and alignment with the entrepreneurs, with their vision, with where we need to be as a company, to make sure that they're bought into that vision, because if they aren't, then the deal's going to fall apart. And so, while I wouldn't discount the negotiations, the things that get you to yes, the things that often do get you to yes are the things that aren't on that piece of paper. And they're the things that allow us, I think, as a company, as a business, as a company really of entrepreneurs, where we've done dozens and dozens of acquisitions, we can quickly get to that point of alignment so that we can actually have transparency with the entrepreneurs and also get a deal done quickly. So I would say, we probably, more than other buyers in the market, tend to have pretty fulsome term sheets, and we do that so that we can move fast. We don't simply put a price out there with a no-shop. We want to make sure that going eyes wide open into the deal is the best way to go from term sheet to definitive, so that we can actually move in a really efficient manner, so that we don't disrupt the entrepreneur's business, and also so that we don't waste a lot of people's time.
Great. Peter, so we've already heard the term fund physics. Maybe you could define for the audience, what does that mean, fund physics? And how do you operate with, in the new world of venture investing with such a large fund, a relatively small group of partners managing it, and the cost of starting a mobile app or something is getting lower and lower?
Yeah, I think, actually, I don't exactly know how to define fund physics, but I imagine what it's, there's different size of funds, and given that there's going to be, it's like a small, if I play basketball, I'm not going to play like I'm a center. There's a certain type of strategy that you have to follow because of your fund size. And, we have a $675 million fund, and, on average, each of our partners invests in a deal maybe 2 a year. So we actually have a relatively slow pace when we're actually doing what we call, a full deal. That being said, we do seed deals, and we do quite a bit in a fund of where we do eventually 40 to 50 companies. We'll seed roughly 40 to 50 companies along the way, and not all of them become, full-size deals. We do that. But where actually there's some, it's not even the size of our fund that makes a difference, but where we get limited in terms of the number of seed deals that we can do is that when we do a seed deal, we put our name on it. And if we back away from a company then that's going for a Series A, it doesn't reflect well on the company, and hence it doesn't reflect well on us relative to the entrepreneur if we don't do it. So when we get involved with seed deals when we get involved, we do things at a very early stage. For instance, we were the seed investor in Snapchat. We put $1 million in there. We have to do it very carefully. And we do that in a way where we make sure that when we invest in a seed deal, it's not sort of, well, we're not really quite sure about the entrepreneur or the opportunity, and so maybe we'll put in $500,000. It's got to be more of, if we put in $500,000, can they get to a certain level of traction or some evidence or some runtime with the entrepreneur where if we project forward from there, if they hit these milestones, we would be really excited about putting together Series A with them and being the lead investor. So what we try to grapple with is, even though we have a certain size, we still try to play at the very early stage. We believe that what we really want to do is help create growth, not pay for growth. We don't want to be in the C round where it's already our colleagues and competitors have helped the entrepreneur create the growth and we're paying up for it. But it actually breaks out, and I don't think we have the time to go through it, but it does break out that if we maintain a moderate investment pace over a 4-year period, and we put in very few dollars on average up front, and then we really meter in the money over time as risk gets taken out. We put on an average of $13 to $15 million per company, that actually the economics do work out. Now, the other part of your question is really that you have a lot of other funding sources when the cost of starting a business, in particular on the consumer side, has come down. And even on the enterprise side, because Intel processors can do all sorts of things, you don't need to have fancy semiconductors to do it anymore. The cost of business has come down. And we actually view that as a real benefit, because there's so many ideas at an early stage we don't know if they're going to succeed or not. And we really view the angel community, the crowdsourcing community, and the super angel community as being incredibly additive, because technology has become a bigger and bigger part of society, and innovation is coming in much more unpredictable ways that you can't tell. So
Peter, let me jump in a minute, just because I'm conscious of Pitch. Johnson's got an important dinner to get to in San Francisco, and I want to come back to Pitch. But while we're on this theme, Steve, I can appreciate that VCs with large funds, when talking to their LP investors, are saying, we're going to invest in many companies at the seed level, and those that are doing well, we'll put more money into those. But this breeds something that people are referring to as negative signaling. Steve, you've seen VCs get into seed investing and also putting big amounts of money that move the needle on their funds. Maybe you could talk about what is negative signaling and how is this changing in the Valley or around the world?
Yeah, I guess what I would say, I mean, we see that happen. We don't do a ton of seed deals. It's probably 10% or 20% of the total number of deals we do, so it's a little bit different than what Peter talked about at Lightspeed. What I would say is that it's very much, if there are a number of investors out there who are investing in lots and lots of companies, putting a small amount of money in, whether they would define it as putting their brand on there or just getting a seat at the table so that they get an option on the next round when the risk is a little lower and they can see a little bit further down the road. I think when we see a deal, so maybe I'll just turn it around, when we see a deal that someone else has passed on, and maybe that's the way to look at it, we're pretty sophisticated investors. We're out there. We take it case by case. So if it's a firm that does lots and lots of deals, and maybe they weren't that close to the entrepreneur, and for one reason or another decided, we think this other company over here is better, we don't. I would say it's not a negative. If it's a firm that we know does very, relatively few deals, Venrock does a deal a month, maybe a little bit more than that. So another firm like ours, and there are a number of them on Sand Hill Road, they walked away from a deal, we take a pretty hard look. So I would say, I always describe the way Venrock works is we're very much stock pickers. We do everything from healthcare to social to semiconductors and clean tech. And we basically just take a hard look. So I think the negative signaling thing, probably, I don't know, not fair to say this, probably makes good media, but the reality is we're going to take a really hard look. And the only thing I wanted to add, and so many good comments here, it's hard to add a little value at the end, but I would say one thing. So I was in 5 startups, CEO of 4, and one that went public. So I mostly probably wasn't put on this earth to be a venture capitalist. Just known Venrock for a really long time and got that phone call, and before they could hang up, I was at the front door. You know, it was a very nice call to get. But what I would say is, from the other side of the curtain, the hardest part of this job, I think, is saying no. Because, I mean, we see thousands of deals a year, and we do 1 a month. So I mostly say no. And so my observation about the industry, and I think it was great to hear the comment, you know, what's changed lately, and we've got a lot of experience on the panel here, much more than me, but there's a diversity of funding opportunities. And, you know, I wouldn't say there's a match for everybody, because you got the corporate and the angels, and you know, and there's still some government money here and there. There's a variety of strategic money, a lot more strategics than there ever were. So I would say, you know, when you just keep in mind, I was flipping through Andrew's book, and, you know, our VC's arrogant, and, you know, again, from behind the curtain, it is, you know, definitely, we've got this model. Our model is very much the same as others. We need the billion-dollar outcomes. We need a few of those to make the fund and to get the returns, you know, that the LPs expect. And so we're just very selective about what we know best, what trends we think are going on, and it's our opinion. It doesn't mean that you go next door and you're going to get the very same opinion. So all I would say is be relatively, you know, be understanding that we don't do that many investments. We have a model, you know, that we all talked about, and you know, there's a lot of ways to skin the cat on the investment side. So I think it's, you know, very much a very personalized thing. The relationship comment is extremely important. Can't emphasize that more.
And by the way, I did a poor job introducing Steve. I was talking all about Venrock and the Rockefellers. Steve was, you know, at a big corporate of was at Nokia and HP, and then he was CEO of a bunch of companies before he became a VC. So you can see that perspective even up here right now. Pitch, I think you once said to me that every company has a moment, like a moment that makes the company. And with Amgen, it sounded like it was a staffing decision. Maybe you could talk about that.
Well, I think the moment occurred in our backyard. We got the company going with the scientists from UCLA. It was it had about 5 ideas for using, in putting genes or making chemicals and things in different organisms. But we needed a president. It was just a little scientific company, so it was thrashing around. So with good luck, we met a man named George Rathman, who was on a sabbatical from his company, Abbott Labs, in UCLA. And so Bill Bowes, who was the original investor, and I, who shortly after, met with George and said, "Would you like to come out here?" He says, "I don't want, my wife would never come out here, I'm sure." So we managed to get the family all out to Thousand Oaks, and then eventually down to the beach communities, and it turned out they did like it. And so we brought George up into my backyard and said, basically, "Will you marry us?" And we weren't on bended knee, but almost. So that moment, I mean, that was, without that moment having been successful, I would say, that's very early on, without George Rathman, essentially with the entrepreneur, by the time when we got him there, Amgen wouldn't be what it was. He differentiated among things. He decided to concentrate on human hormones. We learned to make, later on, we learned to make human hormones in different mechanisms, E. coli and Chinese hamster ovaries. And Amgen built a whole series of products, starting with EPO, which made the company. So I would say there was a moment, and that moment was George Rathman agreeing to be the president of the company.
Thank you. And Gary, I'm sure everyone here has had a Starbucks meeting where they're talking about the Instagram, acquisition. I'm sure there's many we could talk about, but I'd like to hear from you, your perspective. What happened from the company side that are maybe even lessons learned for another company? Maybe it wouldn't be $1 billion deal, but it could be better than had it been otherwise. And then also, what's the Facebook perspective on why that was a good deal?
Yeah, I think we've had a lot of learnings from the Instagram acquisition. It was really our first strategic deal in terms of traction. Kevin and the team and Mike had clearly built an orthogonal network to Facebook, right? It was a business model that, while not generating revenue, was sustainable from a user growth perspective, clearly had demonstrated a lot of synergies with the types of things that we wanted to do. And there was clear alignment between their vision of what they wanted to become and the vision that we had as a company with Mark and team at Facebook. Since then, obviously between announcing and closing the deal, the company had grown significantly. They were just launching. They were only on iOS at the time and had just launched on Android shortly thereafter, and are now, I think, I forget the exact numbers, but north of 5 times their size of when we actually did the deal. So the unique perspective there, I think, and one of the things that we've since sought after in the market is looking for companies where there is that opportunity to sustain a brand. So, the most recent example of that for us is a company called Parse that we acquired on the developer side. They had significant attraction for developers and had a platform that was sustainable without Facebook, but more importantly was highly complementary to the types of services that we wanted to offer. And I think that's where you can find real value in companies. These are companies that have built, like I said, a foundation beneath them, whether it be users, consumers, developers, or advertisers. And in the case of Instagram, it was consumers. In the case of Parse, it was developers. And both of those companies today, to this date, operate within Facebook at our campus right up their street. But they have a sense of sort of directed autonomy and even, some would argue even more independence than that to make decisions, to integrate with other technologies. And that really was the recipe to success. That and also the combination of being able to be free from, paying your payroll and taking the trash out and having to, manage all the overhead that comes along with running a business to just focus 110% of your time on product. Which, if you talk to Kevin or Mike or anyone on the Instagram team or Ilya or James or Kevin from Parse, they'll probably tell you today they're actually operating at a faster pace than they were operating as a startup, even though they're within a larger entity like Facebook.
It's a unique story, and some of the lessons that seem to come out from different people talking about it in my book were, they were lucky enough to be wanted or courted by VCs, wanted by Twitter, and feared by Facebook. So that if $1 billion represented 1% of the market cap of Facebook, and my wife loves the photo sharing element, that was part of the driver for buying the company. Venture investors like these guys, trying to move the needle on their funds, they invested in response to a Twitter offer. Maybe you could talk about how do those dynamics play in. We don't need to make it all about Instagram.
Yeah, absolutely. I think there's always going to be a difference of value between how we're looking at businesses. Oftentimes, we're looking to find ways in which we can, it's not something as simple as applying an ARPU to a user and then plotting out a growth curve, right? It's looking at much more strategic value that we could gain. Obviously, at the core of all of our acquisitions is the talent and the team, much like what I'm sure my colleagues on stage here are investing in. It is the vision and the team that's going to execute on that vision that's really ultimately responsible for the future growth of the business. So while we can provide inherent value in things like scaling out infrastructure, adding the core growth values that we apply to grow Facebook worldwide to their models, there are definitely things that we look at that on a standalone basis just simply don't exist. And I think that's where we can ultimately drive value. But it's going to be different in each case. In the case of Parse, it's looking at the three tiers of our platform that we're looking to grow out for developers, and applying those principles, how we can grow, engage, and monetize that user base, and also bring tools to developers that they hadn't had before, so that users ultimately get the benefit. But yeah, the calculus is different on each company, and I think it's different for us than what the VCs would be applying.
Okay, well, this is for the whole panel, but maybe, Pitch, you could talk about this first. What are some current investment themes that are driving your venture firm or you personally that you're interested in investing? I think healthcare IT the last time we sat down and talked about. Yeah.
But our team.
Yeah, and this is for everyone,
Well, what we've
even in
done
Facebook.
is, since I become the limited partner, we're not a company that raises money outside. We use, every so often we have a friend or two, but basically it's a company that's financed in-house. And so we're smaller, naturally, but we have really two parts of our office. One is a family office that does all, foundation and looks after our personal investments. But the main thing it does is invest in other venture firms, almost all in our own firm. And so the way we work is that we have 3 channel partners. One's a very entrepreneurial doctor, one's a PhD in computer science, and one has been a software guy with a career as an Air Force pilot, I might add. So that the way we work is we have a family with an in-house venture capital firm. But they're separate, corporately they're separate in lots of ways, and I don't play a role in trying to make their decisions. So it's a big investment and an important investment for us, but Skip and Lou and Rich, the guys I'm talking about, are a venture fund, but they have the blessing of having only one limited partner.
Well, the healthcare IT space is clearly one that's attracting interest beyond just, with your firm. What are some other investment themes you guys are interested in?
I can talk about one key theme that's flowing through a lot of the investments we're making these days is business process reinvention across the stack and across a variety of different verticals, including education, digital health, advertising, financial services, and the specific areas that I'm looking at these days are retail and commerce innovation, an area that I'm calling life tech, so where all the different areas of our lives as consumers, in particular the functional and sort of service areas where we spend money, are being not just digitized but optimized and automated. And then the third area is labor innovation. So there are just a whole bunch of different areas where labor's again not just being digitized but optimized and automated. And that was actually one of the key things that we found very compelling about Rocket Fuel Media when we made that investment. It basically automated the entire real-time bidding process into the ad exchanges, and that company just went public a few weeks ago. So that's just one thing to look for.
The area of big data has been talked about a lot, and we certainly invest in companies that are platform companies in big data. But we really moved on from there, and one of the areas we're focusing on are applications for big data. So we see this continual cycle over the years where you have platform companies and infrastructure companies, you have applications companies, and then you have to have companies to help manage those applications or infrastructure. So on the big data side, it's really moving towards the applications. We have a company that uses big data to optimize search engine optimization, as an example. There's another one that uses big data to actually do credit scoring on consumers, and they issue debt. They basically make loans, and they can't rely on FICO score, so they actually go into your Facebook page, they go into your bank accounts, and it's all big data driven. And if you didn't have big data infrastructure, you probably couldn't do it very cost effectively. So that's one area.
Have you seen the valuation of Wonga in London?
Yeah.
I mean, that company was a small company. I remember their Series A and their Series B, Errol Daimlin, and now it's at, $2.5 billion last time I looked, so that's a big business.
Yeah, it's amazing, and they did it in a very focused way in the UK. And so this company I referred to is called Zest Finance. They're actually down in LA, and one of the founder, the CEO, actually he was one of the first VPs of engineering at Google. So really a technologist, and he paired together with a gentleman from Capital One who understood consumer marketing, consumer risk profiling, and things like that. And
before we go further, Pitch, if you need to leave right now, I understand it's you've got about 1 hour or so.
I got 4 minutes.
Okay, very good, sir.
It's part of my time to ask that guy. Ask the guy who took my car keys to get them back to me.
Is there someone who can help out with that? Make sure we've got Pitch Johnson's wheels. Is Steve?
I'll just throw in one last one. It's a fun one. So I've always been the infrastructure guy, and sort of what goes along with the big data, is the interface to the real world. And so I always think about sensors or transducers. So whether it's the Fitbit or whether it's sensors, GPS sensors, or in your phones, they can track, do traffic. We're in a company called Inrix that does traffic tracking. So just to give you a sense of how forward people are looking now. So what's the ultimate sensor? Something that sits above the world. And I think about satellites. And you think about, well, how could you put satellites in the same sentence or the same paragraph as a Fitbit? Cost $20 to make. Well, there's a half a dozen satellite companies out there raising money now, new satellite companies that are literally not a $40 million satellite, but a $40,000 satellite. So now the sensors are almost throwaway. As a matter of fact, they don't even use the radiation-hardened chips. They don't even use all of the fancy stuff that NASA used to use. They just use standard consumer parts. They run for a year or so, then they burn up in the atmosphere, and they put some new ones up. They throw them up to the space shuttle, and they chuck them out there at 100 miles up. So there's going to be hundreds and hundreds of satellites up there sensing everything from what we already know, weather data, agricultural information, information about how many cars are in the parking lot. Starts to get scary. But just the concept of a sensor, something that's very inexpensive, the last thing you'd ever think of, it's happening. So there's a lot of dynamics, not only in the software world, but also in infrastructure.
Cool. So I'm going to open up the panel to the floor for questions, but I've just got one question for Gary, which will be my last question. I've never met Mark Zuckerberg, but I've seen the movie. Is that movie accurate? Is that what he's actually like to work with?
I don't think we endorsed the movie.
We're recording this.
Yeah, of course. But like I said earlier, like we wouldn't be where we are today without Mark. Obviously, I think just I spent the first half of my career at Apple working with folks like Steve Jobs and Johnny, some of the most innovative people in the world, and I would put Mark in that category of leadership. That he, like many of the folks at Facebook today, are the reason why we are over 1 billion users, and they're the reason why we're doing things like internet.org to start looking at continuing the ways in which we can actually enable people to interact with one another, whether that be through satellites or through a mobile device. And we're just really fortunate to have him as our leader. So I guess the answer is no.
Okay, very good. Okay, great. That was just for fun. So if anyone has any questions, I don't know if we have microphones so we can pass around to the floor.
So you mentioned space. And except sensors or satellites, I think there's a new emerging market around what's happening in microgravity and on orbit. Has the investors and VC world looked into that as a potential for disruptive innovation? And what's your take on that?
So I'm sorry, I missed the question in there, but
So there's a great potential for microgravity research or space-based research beyond sensors or satellites, and has the investors world and the VC world looked into that?
So I give you this. The short answer is, I think new ideas come along every day. I think the ones that are being driven now are the ones that exist but have been very expensive. So I think it'll move in directions other than what we've seen. But if it costs $50,000 to get a 1 meter picture of a square kilometer, if you could get that down to $1, that would be an innovation. So I think the space activity that I was talking about now is sort of related to existing applications, reducing the cost dramatically. I understand your question about microgravity and other things. Probably out there are ways.
Well, very good. If that's it, I'd like to thank everyone for joining the panel. Oh, we have another question? No. I'd like to, it's like an auction. You bought it. No.
You guys mentioned sort of investing in founders and entrepreneurs. I was curious, can you just say what are the 3 primary characteristics you look for in an entrepreneur or a team of entrepreneurs when you're deciding to get that done? And how do you vet them?
I think sounds like a buzzword, but vision. So I think very few people actually, I think it's sort of like very few people actually have vision to go create something. It's vision where it's not just fluff, but they conceptualize something and there's just something very concrete that drops out of it that they may not even be able to write it down in a PRD or MRD, but they have a mind's eye of what they want to do. I think that's one really key important thing.
I'd agree. I mean, three that we look for certainly are the grand vision, but then also being able to build the team, the product to be able to execute on the vision. You've got to have a connection between the vision and the execution. And also entrepreneurs who really understand the market. They understand the market problem, they understand the market, they understand how it works, so they can go immediately to execute in the market. Those are three that we look for.
The one I'd add is humility. Like it's in our culture. I think we're a pretty humble company, and associated with that is curiosity. Because I think if you have, and they're actually the inverse of one another, if you have an ego, oftentimes it'll get in the way of being curious, and you'll oftentimes just go astray. So we actually really look for that type of cultural fit and that type of humility in our entrepreneurs that we're investing in.
Thanks. You mentioned investment themes. The media has mentioned how a lot of venture capitalists were interested in the consumer space and now have moved to the enterprise space. Is the enterprise space passé, or are you still looking at both consumer and enterprise from your perspective?
That's an easy one, and I think the answer is yes. Very, very, very different markets. I think the thing that jumped out at me when I first got into this business is, historically you can diligence the enterprise deals. You can knock on doors, you can talk to companies, you say, how are you spending your money? What are you spending it on? What's the plan? And, what do you think you need? And you can make an educated guess as to what's a couple years out, and then you can make an investment. On the consumer side, it's pretty difficult. I mean, there are visionaries, and there are, that have been able to get way out in front of things and say, you need to have these things. But many of the companies that are out there that have become very successful, and I think somebody said this earlier, I think it was Peter, is pretty hard to see. And so that's a very, not universally, not absolute, but it's much more metric driven. These tens or hundreds or thousands of companies that get seeded on a regular basis, it's in the consumer space, let's get it out there for a relatively small amount of money, hundreds of thousands of dollars or less, get your product on the net, or whatever kind of product it is, get it out there, see how viral it is, and show us the metrics. And we're very metric driven on the consumer side. So I don't think it's gone away. I think it's just, for us, it's been very clear on how we reduce risk.
Yeah, I think that, maybe it's not a good analogy, but it's, the Israeli-Palestine conflict is ongoing all the time, but the press highlights it from time to time. When they have nothing else to write about, they come back to the Israel-Palestine conflict. But it's always existed. So I think, the enterprise has always existed, and the consumer areas will always exist. But we're just human, and we can't help but get caught up in emotions and waves. We make more of them than they are. But I think that most venture firms keep their eye, especially at early stage, we're really investing bottoms up, and we're not really, you have to pay attention to the trends, but usually when you're investing into a trend that's in the news, you've already missed it. It's like a wave, and the surfers miss the wave. You're maybe getting crushed by the wave, you don't realize it.
Yeah, I would add that we're very thesis-focused investors. So each of us, we call it sort of two majors and a minor at any one point in time, which means the onus is on us to know those areas very, very well, so we can recognize opportunity when it comes and sort of be looking for the areas of opportunity that we believe exist. So we really tend to not get caught up in hypey, high valuations and the swings. We just have really tried over the years just to build businesses, real business models, real revenue, just build big businesses. And that, again, we've had Rally and Rock the Fuel go out and go public in just the last few months, so that's our focus.
We're in a period of hyperactivity right now with valuations and with investments and things like that. What do you think the landscape looks like in another 5 years as a lot of current funds mature?
I would say one thing, there's probably going to be fewer funds. I think the hidden in your question is, what does the investment landscape look like in 5 years? And I think there's just going to be a much bigger diversity of investment vehicles. And I think it's pretty much been, there's a pretty steady trend towards venture is shrinking in terms of the number of firms. The number of dollars has been bouncing a little bit, but I think it's been drifting down some. I think it's slow. The drop is slowing, and I think it's for a whole bunch of reasons. A lot of companies don't need as much money and don't fit the models of the bigger firms, so it's opened opportunities for other kinds of investments. There's angels, the super angels, the strategics, but I think the landscape is just really different in 5 years.
Beyond that reality, and I agree with that, do you think that retail investors that are accredited investors, corporates, and classic investors in the venture capital asset class in the United States and around the world, should they be investing in the asset class? Do you think they would be wise to put money into venture capital funds?
I think that the venture business is a network business, meaning that a firm is really as good as its network of relationships, and if you do have a network, you have a lot of power, or you have a lot of advantages over a competitor that has a less good network. So I think if you can find a venture firm that actually has that network, and you believe that there's going to continue to be technology disruption or technology-based disruption, which can be consumer, but it's based on technology, and you can invest in companies, firms that have that network, I think you can get superior returns relative to investing in other areas. But our own LPs, our own investors say, look, venture is a tough asset class, because if you're a large pension fund, these guys have tens of billions of dollars they need to put to work. And each venture firm can only take so much of the capital. We don't want our whole fund based off of a few investors. So it's hard for them to invest. So they may get a little bit of a return, hopefully a good return, but they can't put that much money to work. And so I think that there are some issues around that, but technology is growing as part of our lives. I think it's going to go, I personally believe, unabated for quite some time. And to capture that growth, investing in a good venture firm is not a bad way to go.
Well, good. Well, I want to taste some of this beer, but maybe we'll take one more question back here.
I would really appreciate if all of you would comment on crowdfunding.
Crowdfunding.
Yes.
Okay. What's the latest thinking on crowdfunding?
I'll just sort of connect the last comment with your question, and that is, they're clearly we've seen, with the recently minted millionaires and billionaires. There's a lot of, there's this whole Series A crunch kind of comment about so many companies seed funded, and then there's not enough A. So in terms of venture, two comments. One, networks matter. What's happening in the shrinkage of the venture community is a definite flight to quality. So the best networks, the best firms are going to be the ones that are around in 5 or 10 years. So plenty of money or significant money on the low end, and then you got the PE firms that have hundreds of millions of dollars to put the work on the high end. I still think there'll be a very, very, a long life for venture. There's still a lot of risk in there, and it's a very sort of specialized investment where you need a significant amount of money, but the risk is still very high. So I don't think it's going to go away. So in terms of crowdfunding, I think it fits really well beneath venture. I don't think it replaces venture. It still doesn't replace when you need 10 to 50 or 10 to 70 million dollars.
That's exactly what I was going to say. I think it's highly complementary to venture. Anything that, given the lower barriers to entry these days of starting a company, anything that helps to foster innovation in the very early stages is a good thing, as far as I'm concerned. And it just provides us yet additional signals to be able to look to when we're trying to assess and analyze and due diligence on Series A, B, or later stage companies. So I think it's good for the ecosystem overall.
What about the requirement for general solicitation that is part of the crowdfunding?
506C.
Yes, how does that affect the company if they go through that when they approach you guys for funding? How would you view that if they got through that?
Yeah, so the question is, we had after 80 years, the ban on general solicitation was lifted. We went through the public comment period, and on I think the 23rd of September, we actually saw what it would take for a company to go into general solicitation, and it's 506C. If anyone's familiar with that, would you care to comment on if you think it's a... You haven't seen it yet? Well, I mean, if I was 60, surprised me. I was excited by it and thought we would go into general solicitation for our own VC fund to run in concert with our angel group, and we chose not to go that route. So we thought that the burden of complying with FINRA and the SEC was too great, and that we're better off not being a guinea pig, as a venture fund, to do that. For example, if a startup, I mean, guys, listen to this. If a startup makes slides that they want to present to you, if they were presenting here, I'll bet you some would show up with a USB drive at the last minute saying, ooh, Andreessen Horowitz just invested, I got to mention that. You're not allowed to make changes for 15 days after you've submitted, your deck to the SEC, and it goes on. It goes on from there. So I think we're still finding our way. I think that there'll be some entrepreneurs for whom that's a very good fit. It's a good idea. They're able to go out to a broad base of users for something that consumers can understand, or leverage a large doctor network or something that they have access to. But I think that the smart, well-connected entrepreneurs of the world will be able to network their way here, and they'll be able to benefit from the flexibility of not complying with a whole lot of new, unfortunate laws coming from the SEC. Hopefully this will change. Two more questions, and then we're on to me talking about the book and beer.
So Saturday, the CEO of Optimizing was talking about a really clever way to hire board members. It was through a mock board review. What was the smartest way that you have seen somebody hire a board member as an entrepreneur?
So the question is, what's the smartest way the panel has seen on how to hire a board member?
Do you mean an investor or an independent board member?
Actually, I don't know.
Oh, okay. So, because becoming an investor board member, that to me that's a much longer process, right? It's not. From my perspective, I used to be really early on excited about going to board meetings, and then you quickly realize that 2 to 3 hours sitting in a room, that's not actually where a lot of the work is accomplished. It's in fact between board meetings. So, I'd say if it's the investor, then is that person going to generally be helpful? Do they have a relevant network? Do they have depth of knowledge in their ecosystem? Are they going to help you strategically and operationally? I mean, that's generally what you should be looking for in an investor. In terms of an independent board director position, it's a two-way street. I mean, often the independent board directors that we're looking for, these are highly successful people who can choose which boards they're going to be on. So we often advise our entrepreneurs to go out to dinner with them, to get to know them, to understand, is this person going to be aligned with their vision, be actually helpful and additive to the dynamic and the skill set that's already at the board level? Is this person going to not be disruptive and be helpful in the board meetings? I mean, those are all things that we ask our entrepreneurs to look for, but it's absolutely a two-way street because they have to be selling the opportunity as well.
I'm involved with a company, and the CEO and a good part of his management team are triathletes. And so they invited a board member out to a track workout. And I think it was more, not necessarily they wanted to see that the person could keep up with them, but it was sort of a test to see the reaction of, okay, will they be part of the culture? Are they as intense as we are? It was symbolic. But I think I think good entrepreneurs spend a lot of time informally with potential board members and get to know them as people, and really understand what makes them tick and how can they add value and how are they going to react to situations. Because when you're on a board, part of it's logic and part of it's emotion. So understanding the full person is really important.
So I know there's more questions, but I think hopefully some of the panelists can stick around, and I'll try to talk through a little bit about the book now, and then we can try some of this local brewed beer. So thank you once again, everyone, for helping me out and joining me today.